Charles Hoskinson, pretty much all but came out and admitted defeat for Cardano. And I'm sorry, one sec, I screwed everything up. Hopefully you all don't bail on that first 10 seconds because it was horrible and I'm going to start over. So hopefully I get to edit it out. If you're watching the replay, stick with me because that never happens. But over the last 24 hours, Charles Hoskinson came out and pretty much all but admitted defeat for Cardano as the tokenization storyline continues to unfold. A lot of people are completely missing this shift that's taking place in crypto right now. And to me, every day becomes more and more clear. So right now, Charles Hoskinson came out yesterday and pretty much all but admitted defeat for Cardano. We heard from Arthur Hayes saying that he's now selling off his bag of Hyperliquid and Near. We've got people from Bankless selling off all their Ethereum. I mean, everyone is panicking. Michael Saylor sold Bitcoin yesterday. We saw Bitcoin tap 61,000. But tokenization continues to run forward. The news continues to run forward. So let's hit the like button. Make sure you guys engage in the chat. This is going to be one of the most important streams that I do. The information in this stream, to me, is what's going to separate winners from losers in this next crypto run. Call it a bull run, call it whatever you want. 4-year cycle, I don't care. But I do think that the information in this stream is where the real profits are going to lie for retail holders. My opinion, not financial advice. I am not a financial advisor. You should always do your own research. But let's listen to a little bit of what Charles had to say yesterday. He has been running for the last 3 months like an angry toddler crypto bro, stomping his foot on X to anyone who will listen about everything that is wrong with blockchain. This explains why he's been so angry, in my opinion.
This is where we're at as an ecosystem. You know, I said at the beginning of the year, we're going to see a lot of people collapse because the markets are really bad and we need some way to bail out our ecosystem and get them the lifeblood that they need to get to the next level. So I came up with a plan of an index. It did not get executed. So we've lost JPEG Store. We have tap tools. I would suspect others are coming very soon. There's going to be a wave of failures in the ecosystem. Now, I could buy some of them as I did NAMI and as I did Blockfrost, and then we can try to take those and commercialize them. When we try to take them and commercialize them, you guys vote against it. Just the way it is. So there doesn't seem to be a lot of community desire to spend the treasury to take these ventures to the next level. We have Draper. You've decided to give them a large quantity of ADA, a lot of money. As I remind you, they're probably going to invest mostly in new things, not old things. And of these old things, many of them are not in an investable state at the moment. So this year's going to be very hard. The second half of the year for Cardano, we're probably going to see more dApps in DeFi die and a consolidation happen. I'm not exactly sure what my role or place is to resolve this.
And he went on later to say that he's taking a break. But the thing is, he's supposed to be the face, the leader, but he has zero control. And he mentioned something specific I want to point out. They mentioned bringing in Draper. Many of you may not recognize that name. They are heavily involved in tons of blockchain infrastructure, including heavily involved on the Canton Network. So basically, Charles is like, okay, we're bringing in the institutional guys. We're trying to change governance, but you all keep voting against it. This is why having random people control the governance of a public blockchain is not optimal and why many institutions are just not going to go that direction. He's talking about trying to commercialize, or in my opinion, institutionalize the blockchain, and they're voting it down. But that's where the money is. So basically, Charles Hoskinson came out and said, our blockchain is failing. Here's why. You guys keep voting against it, and I can't really do anything about it. That is not a good look for Cardano, but it certainly explains why he's been so angry and stomping his foot, because things have not been going the way of his blockchain. And this is why I want to point this out. I said this is going to be probably the most important, and it's honestly nothing to do with price. I'm not pumping a token. I want to understand, or I want to help you understand what I believe is the most misunderstood piece of what's actually happening in crypto moving forward, and how we can actually really, as retail, earn and participate. Because the next crypto cycle, in my opinion, is not going to look anything like the last one. I'm not saying the 4-year cycle is dead. I'm not saying any of that nonsense. You can come up with your own narrative on Bitcoin if you want. I'm not even talking about Bitcoin. My opinion is the old cycle was focused on meme coins. Meme coins ran this year. It's been about gambling, and why retail's been gambling their money away into nothing and then into prediction markets. Again, and we are all retail. I've lost money here in this pullback too, but I've been dollar cost averaging in. So it's been all about meme coins. It's been all about yield farming, unsustainable yields, and mercenary capital. Be honest, you guys didn't really get excited about Canton until I showed you can make 8% return on a yield. This is true. Okay, but we're going to touch base on that. We're going to come back to it. It's not a bad thing. Speculation, pump and dumping, and short-term thinking. This is obvious. The majority of crypto holders, especially majority of retail holders, can't think more than 10 minutes in front of their face. So when we have a pullback like this, a lot of people aren't properly invested, didn't do their proper due diligence into their blockchains, and, price falls and they hop out, take the loss, call crypto a scam without ever fully understanding its real use case. And price charts, volatility first and hope over fundamentals. We've heard that narrative play out countless times across countless narratives. But in my opinion, tokenization, and I've said this for months, is happening, and everything's being tokenized, in my opinion. Just about. If it has a reason to be tokenized, it's going to be tokenized. So tokenized stocks, real equities, and real on-chain ownership. This is going to be important. Tokenized treasuries backed by real-world yield with trust. Stable coins, again, backed with U.S. Treasuries, programmable money, and 24/7 institutional settlement that is compliant with what institutions want. This is the new tokenization cycle that's coming forward. Again, everything's being tokenized now, but over the last 6 months, what people have not said, I guarantee you almost no one's talked about this, the difference between a true tokenized item or a true tokenized stock or treasury or bond. The difference between a true tokenized stock and a synthetic tokenized stock, because this is where things are going to get interesting, okay? Because if you're not playing by the correct rules, and I'm going to touch on those rules in a minute, then you're not going to be participating with the correct tokenization rails. Visa is testing the next generation of settlement, privacy, compliance, and tokenization, partnering with Brale to run a new pilot on Canton Network. This is institutional grade. It's built for banks, fintechs, and enterprises, creates atomic settlement. Again, atomic settlement means either it settles with both parties or it doesn't settle at all. If a change needs to be made, both parties have to agree on the change. This gives global reach and, again, opening up programmable money. Privacy-enabled rails for institutional settlement of stablecoins through Visa. Again, exploring stablecoin-based settlement using SBC on Canton, a proof of concept evaluating how privacy-enabled infrastructure can support institutional payment flows while maintaining control over sensitive transaction data. So now we've already talked about the tokenization rails. Now Visa is implementing stablecoin rails via Brale. This was just announced this morning. And I know everyone's fawning over the DTCC, which is great for Canton. Don't get me wrong. It's also great for Stellar, as we just found out recently. And everyone's fawning over that, and that's great. But again, what creates burn on the Canton Network? Transaction volume. And fees, right? The fees can be $1,000. They could be 2 cents. It doesn't matter. But we want to see the burning of CC. And Visa, the amount of volume of transactions that they represent, even if we get a piece of that actually running through the global synchronizer, or if they move the burn to the private synchronizer, if we get a piece of that, which it looks like we're going to, depending on how big that piece is, that amount of volume can rival the DTCC. Truthfully, just the amount of volume. Now, granted, the amount of money behind the volume won't be the same, but still, transactions create fees, fees create burn. To me, the most important project that comes out on Canton is the one that's going to burn the most CC or contribute to the burning of the most CC somehow. That's what I'm always paying attention to. But this was just announced today. And again, tokenization makes assets programmable. And we're going to really focus on tokenization right now and what it means for you, the retail holder. But before we do that, we need to understand the difference in tokenized stocks. So a traditional stock, you get a stock certificate. It's paper-based, slow to settle, limited access. It's not very liquid for a paper stock. Now, again, this is going really, really old school because we do have digital representation now, but it's not the same as tokenization because now we do T1 settlement, not necessarily T2. Blockchain gives T0. But anyway, it is a paper certificate creating ownership. It's fractional ownership, instant settle. Okay. Sorry. Tokenization makes assets programmable. Fractional ownership, own a fraction of any asset, lower barriers. So instead of maybe, if you can't afford, 1 share of Amazon, then you can get a fraction of Amazon. Instant settlement with T+0 settlement. I just touched on that. Programmable assets with built-in logic, automated compliance, and smart contracts. This is where it's going to get important. 24/7 markets and yield generation. This is what most people don't understand, I think, when we're talking about tokenized assets and why the entire asset has to come on chain. Because what institutions do, say you own, I'm just going to use easy numbers. I wish we all could, but say you own $1 million of Tesla stock. Cool. A lot of institutions will go to the bank and they'll take out a loan and create more liquidity against that asset, against that Tesla stock. Many of you are familiar with taking your crypto asset, CC, ETH, Bitcoin, whatever, Solana, name your crypto, and staking it to gain a yield because that's the actual asset. The ETH is the ETH. The CC is the CC. There's no other representation of it anywhere else. So you can trust that that asset is the asset and is liquid. By tokenizing the stocks, now you're going to be able to take your $1 million of Tesla stock and stake it just like you could your CC, or stake it just like you could your Solana. So it just opens up a realm of investing that retail is not used to, but that only works if they bring the entire asset on chain. And what does that look like? Real tokenization creates legal ownership. You own the underlying asset through the legal title. You become eligible for dividends and distributions, voting rights, and governance. Again, if that's included in your stock. Redemption rights, and it is regulated and compliant. Synthetic tokenization. This is where things are going to get tricky, and this is where I think we're going to see a division in crypto that not a lot of people are talking about, okay? Synthetic tokenization creates exposure, derivatives, and no ownership. They're derivatives contracts. You hold a contract that tracks the asset. You actually don't own the asset. Price exposure. You benefit or lose only based on price movements. That synthetic representation does not give you access to the liquidity that you own by owning that stock. You have more counterparty risk because you rely on issuers, oracles, and smart contracts. There's no ownership rights. You don't actually own the underlying asset. You own a smart contract, which is an IOU. We've talked about that, to the actual asset. And you have no voting rights and no governance. So because you don't actually own the real asset, you own a synthetic version of the asset, you do not get all the rights that come with it. And this is where the SEC stepped in. I talked about this not long ago, but no one's paying attention to it, and it's a much bigger deal than people actually realize. The SEC supports tokenization, but not all tokenization. Not all tokenization is created equal. The rules that apply: approved real tokenization, it has to be the real asset-backed securities, actual ownership of the underlying assets, legal rights and redemption, compliant and regulated, and transparency and disclosure. What is not approved is synthetic tokens, only the price exposure or fake representations. They're higher risk to investors, and they are not eligible under the SEC exemption for tokenization. This was announced shortly after they rolled out their tokenization exemption, and almost no one talked about it other than they pulled back, right? The narrative was the SEC is good with tokenization. Now the SEC is not good with tokenization. And we saw Ethereum pull back. We saw other blockchains pull back. And that's because these synthetic assets exist on a lot of these blockchains, and it's not going to work moving forward. So they have to reflip the script somehow on how they're going to move forward with their tokenization. And I'm going to show you those here in a little bit. But synthetic assets have already failed before this announcement from the SEC. We all heard of Terra Luma, of course, M Apple, M Tesla, and Mirror Protocol. All of these failed in 2022. Shortly after, in 2023, is when we first saw the Canton Network come onto the scene, and they have a different form of tokenization. The asset does not just sit there anymore. When you tokenize your stocks or your treasuries or whatever, that's creating liquidity that you can now go use elsewhere, because you can move the ownership and the liquidity of that asset to potentially not only just hold the asset and wait for appreciation as if you would, typically buy a stock, but you take that asset, you buy it, and then you go stake it and earn 2, 3, 4, whatever percent yield someone may be offering if you feel comfortable with it. 24/7 programmable markets. You will own, you can lend, you can borrow, earn yield, and you still retain the exposure of the asset. You never have to sell it, so you never have to worry about realized gains. You take your tokenized asset and what I plan on doing as this becomes more and more available on the Canton Network, because I like the privacy and safety. And again, there are programs and DeFi being built around this right now for retail holders on the Canton Network. But this is actually what they are focusing on. Every asset is becoming software. Physical certificate is manual and slow. Then we had the brokerage account. Then we had digital security. Now we're moving into tokenized assets and programmable assets. It's going to be much, much faster. Everyone loved the brokerage accounts when we first got Robinhood and we first got Webull. I remember that boom in stocks right before or right at the beginning of 2020. Same thing with crypto, is when everyone got access to trading. There was a boom in volume and a lot of people gambled. The investment question: what happens if every single asset becomes programmable? Well, the real question is, who is tokenizing correctly? And I did a little research, and I'm going to pull that up for you to give you guys some examples of who's tokenizing correctly and who's tokenizing incorrectly. Because in a fully tokenized world, we're going to have tokenized stocks, tokenized treasuries, lending pools, digital collateral, stablecoins. All of it is going to play a part in this tokenized world.